Okay, so let's have a look at this in-class problem 7.1 share valuation question. I'm actually doing this in the OneNote notebook, so any of the work that I do will automatically be synchronized there for you as well. So we have a situation here where a company has never paid dividends, and the president of the company says he'll never pay a dividend in his lifetime, which is going to be 20 years. And the company currently earns $5 a share. That's expected to increase at a rate of 8% per year. Now, the president's daughter, who's going to inherit the company when the president dies, plans to initiate a dividend of 50% of earnings starting when she takes over. That means the first dividend will be 21 years from now, based on the earnings at 20 years from now. And then that dividend will be maintained at a constant level. So this is basically a share valuation question with zero growth. A requirement is, assuming a 12% rate of return, how much would you be willing to pay for a share of the company now? So I'll break this down into a couple of steps. The first step is essentially going to be to project the EPS 20 years from now. And when we're talking about 20 years from now, that's the future. So we're looking to determine what the future value is going to be. So what we have using our calculator is 20N. We have 8IY because if we go back to the question here, the earnings per share is expected to grow at a rate of 8% per year. So that's 8IY. The present value of the current earnings per share is 5. And we're going to put zero payment because remember, this is not a regular payment stream. And so what we want to do basically is compute the future value using our calculator to be $23.30. Well, that's the first step. So step 2 is to use that projected earnings per share to determine what the share value is going to be 20 years from now based on the dividend that's expected to be paid. Well, because this is a zero growth problem, this is basically a situation where we have a perpetuity. So if we're looking to establish the price of the stock 20 years from now, that's going to be equal to the dividend divided by the rate of return. We know that the earnings per share is going to be $23.30. However, remember that she plans to initiate a dividend of 50% of the earnings. So we have to multiply that by 50% to end up with a dividend of $11.65. We'll then divide that by the expected rate of return of 12% or 0.12, and that will give us a share price 20 years in the future of $97.10. We're not quite done yet because this is the share price 20 years in the future. What we want for step 3 is to discount the future share price to today. So we've got 20N. We now have 12IY because this is the rate of return that we're using for our own investment purposes. There's no payment because it's not a regular payment stream. And the 97.10, that was the stock value that we just calculated, will basically become the future value in our calculation. And we will compute the PV to be $10.07. And so that's what you'd pay for this share today, $10.07. You hold on to it for 20 years. The president dies, his daughter takes over, and then starts paying a perpetual dividend that's expected to be $11.65 based on the earnings per share growing at a rate of 8% over the next 20 years.